we are kicking things off with incredible deals. Get ready because Microsoft Office 2021 is dropping for just $29.97 for life. That is $40 less than a full year of Microsoft 365. This is a massive saving opportunity you absolutely cannot miss. We dive into the details of this incredible pricing structure and what it means for your productivity tools right now. Who created the mascot by hand in Blender, and the reaction from the community about this emphasis on human craft versus generative AI. And finally, we look at the stock market frenzy as Microsoft hits a major valuation point. Microsoft is trading at $420, and we ask the big question: buy, sell, or hold? We analyze the compelling fundamentals, the massive Azure growth, and the path to appreciation for MSFT as we get closer to that crucial earnings report. Stay tuned because this is essential market insight. Microsoft has announced a significant pricing structure for its Office suite, positioning Office 2021 as a long-term value proposition. According to reports from Popular Science, the software is being offered for a one-time purchase price of $29.97 for life. This pricing strategy places Office 2021 at a notable advantage, costing $40 less than the annual subscription fee for Microsoft 365. This move signals a strategic effort by Microsoft to cater to users seeking perpetual software ownership rather than recurring subscription models, offering a compelling alternative for individuals and businesses looking to manage their productivity software expenses. Microsoft's AI chief has issued a stark warning, suggesting that human office jobs could face replacement by artificial intelligence within the next 18 months. This development raises significant concerns about the future of white-collar employment across various industries. Beyond the technological disruption, the economic landscape is showing multiple complex shifts. In the Middle East, analysts are debating whether Dubai's economic downturn could present an opportunity for India. Meanwhile, regulatory and investment hurdles are being scrutinized as questions arise about the viability of the NSE colocation case and whether the Gift City initiative can effectively attract Indian talent amidst a growing AI rally in regions like Korea and Taiwan. On the financial front, India is exploring strategic moves to become a global gold hub through a locker-to-exchange mechanism. Furthermore, geopolitical events are impacting energy markets, with the Hormuz crisis and rising crude prices signaling potential windfall gains for Indian oil companies like ONGC and Oil, potentially leading to significant revenue increases. Separately, the stock market is showing bullish signs, with Sun Pharma breaking out from a downtrend to reach a new 52-week high, prompting investor interest in potential buying opportunities. Microsoft's GitHub Copilot logo has ignited a debate regarding the perceived contradiction of promoting an AI-powered tool while emphasizing traditional, non-AI creative processes. The controversy centers on the new animated mascot for the GitHub Copilot app, which was reportedly modeled, rigged, and animated in Blender by GitHub's principal brand designer, Cameron Foxley. Foxley defended this approach, stating, "In the age of AI slop, some of us are still making things by hand, I promise." This commitment to manual creation has drawn praise from some users who value the tangible details in content, contrasting sharply with the tool's AI foundation. However, this emphasis on human craft has led to criticism, with many users questioning the irony of promoting a generative AI product while championing non-AI methods. Commentators questioned whether this signals that the AI tool itself is inadequate, labeling GitHub Copilot as an AI slot machine. The debate highlights a tension between leveraging generative AI for productivity and maintaining a perceived value in human-driven creative execution. GitHub Copilot, a Microsoft-owned platform powered by OpenAI technology, is an AI-powered coding assistant. The animation was created for an upcoming desktop application launch, and the mascot can also be made interactive using the Threads JavaScript library. The discussion underscores a broader industry trend, where even generative AI brands are navigating the complex landscape of creative authenticity and the role of human input in the age of artificial intelligence. Microsoft is currently trading at $420, prompting analysis on whether it represents a buy, sell, or hold. Despite a 12.22% year-to-date decline, the company's AI business remains exceptionally strong, achieving an annualized run rate of over $37 billion, marking a 123% year-over-year surge. This disparity between price action and fundamental strength has drawn investor attention. Microsoft is central to the enterprise AI build-out, driven by robust growth in Azure, which has posted 40% growth across 4 consecutive quarters. This strength is further supported by Microsoft 365, Dynamics, and its partnership with OpenAI, expanding reach across productivity, data, and frontier models. The stock has experienced a steady derating, moving from $517.85 in Q1 to $428 in Q3, despite achieving 4th consecutive earnings beats, with Q3 FY26 delivering $4.27 EPS against expectations on $82.89 billion in revenue. Forward indicators remain compelling. The commercial remaining performance obligations have nearly doubled to $627 billion, bolstered by a $250 billion Azure commitment from OpenAI and Microsoft's IP rights extending through 2032. Valuation metrics appear reasonable, with a 31 trailing and 21 forward PE ratio, supported by 46.3% operating margins and 34% return on equity. However, capital expenditures are high, hitting $30.88 billion in the quarter, an 84.39% year-over-year increase, and free cash flow has seen a 3.32% decline in FY25. Furthermore, OpenAI investment losses widened in Q1 FY26, and the partnership is diversifying beyond Azure for non-API products. Interest rate pressures, evidenced by the 10-year Treasury sitting at 4.59%, are putting pressure on premium multiples. Insider selling in March further signals caution. Sentiment remains neutral, with most market predictions suggesting a May close around $435, indicating no immediate breakout. Despite the recent slide, the technical setup at $423.54 is considered constructive. The path to appreciation is framed by compounding Azure growth at 40%, the conversion of the $627 billion backlog into revenue, and the rapidly accelerating AI run rate growth, which is beginning to overshadow the current capital expenditure burden. The risk-reward profile is favorable, with the base case targeting $523.95. The primary risks identified are a potential slowdown in Azure growth below 35%, continued unchecked capital expenditure without corresponding backlog conversion, or further deterioration in the OpenAI relationship. The upcoming earnings report on July 29, 2026, is critical, serving as the catalyst to determine if Azure momentum continues and if CapEx begins to translate into monetization. Analysts maintain a positive outlook, suggesting that paying a 21x forward earnings multiple for this dominant cloud and AI franchise remains reasonable pending positive signals from the next earnings cycle.